Let's talk about what just happened in the gold market. Gold, long considered a safe haven, just suffered its biggest one-day drop in over a decade, down 6.3%, from nearly $4,400 to about $4,120 an ounce. Silver fell even harder, plunging over 8.7%. For recent buyers, it felt like a gut punch, a reminder that no investment is a guaranteed path to wealth. The speed of the sell-off was shocking. This wasn't a slow decline, it was a cliff. Big institutional money moved fast, triggering a cascade that swept away smaller investors. By today, gold has stabilized around $4,140 but the calm feels uneasy. Is this a pause before another drop or a buying opportunity? No one knows for sure. Before you panic sell or buy more, stop and get informed. Understand what drove gold to record highs and what just dragged it down. This is about more than gold. It's about how markets work and how to protect yourself from emotional decisions. Fear and greed are costly. This week is a lesson in why you must control them. Let's break it down so you can make your next move wisely. To understand the fall, you need to know why gold soared. Gold's rally, up nearly 60% this year, was driven by fear and strategy. Investors lost faith in government finances and worried about inflation eroding their savings. Anticipation of Federal Reserve rate cuts made cash and bonds less attractive, so gold looked better. Global trade tensions and persistent inflation added to the unease. Gold's appeal is psychological as well as financial. It's tangible, trusted, and has a long history as a store of value. All these factors fueled what's called the debasement trade, betting against paper money. As more people bought gold, the price rose, attracting even more buyers in a self-reinforcing cycle. Momentum carried gold to its peak near $4,400 an ounce. But momentum can reverse quickly. When everyone piles in, the risk of a sharp correction grows. The climb set the stage for the dramatic fall. Let's look at how that happened. Why did gold crash so suddenly? The price simply got too high, too fast. After a 60% surge, traders saw an overbought market and started taking profits. When big players sell, it can trigger an avalanche. One sell order leads to another, and the drop accelerates. Automated stop losses kicked in, creating a domino effect that erased weeks of gains in hours. This was a classic market correction, a sharp short-term drop to shake out latecomers and speculators. Even after the fall, gold is still way up for the year. Perspective matters. Last year, gold was around $2,749 an ounce. Volatility itself became a reason to sell as funds sought to reduce risk. This wasn't about gold's long-term value, but about managing risk in a wild market. When volatility spikes, professionals often head for the exits. The less and rapid gains can vanish just as quickly. Corrections are part of the game. To understand gold, look beyond this week's chart. Look at history. Gold has been a store of value for millennia, surviving wars, crises, and the collapse of empires. In times of chaos, people want something real and universally valued. Gold fits that bill. It's the ultimate insurance policy against instability. After the US left the gold standard in 1971, gold became a hedge against inflation and a falling dollar. In the 1970s, gold soared as inflation eroded cash savings. Investors who held gold protected their purchasing power. Today, buying gold isn't just chasing a trend. It's tapping into centuries of trust. Gold is a hedge against the unknown and a vote of no confidence in unstable systems. Whether that's right or wrong in the short term, its historical power is undeniable. That's why gold remains a unique part of any portfolio. Understanding this history is key. You've heard the term debasement trade. It's simpler than it sounds. Debasement means money losing value, usually because governments create too much of it. When a government runs big deficits and prints money, your dollars buy less. Imagine a rare currency suddenly becoming common. Its value drops. Investors respond by selling assets tied to that currency and buying things like gold, which can't be printed. Gold supply is limited by nature, making it the ultimate debasement hedge. In 2025, massive US deficits and likely Fed rate cuts made investors fear for the dollar's value, so they sold dollars and bought gold. This isn't about patriotism, it's about protecting wealth. Understanding the debasement trade explains gold's wild ride. It's a financial calculation, not an emotional one. That's why gold surged and why it can swing so fast. When markets get wild, the urge to act is strong. But smart investors plan ahead. One tool they use is options, which can act as insurance against big moves. For example, a put option lets you sell gold at a set price, protecting you if the market crashes. This week, as gold's price swung, the cost of options soared. Investors were paying up for protection. But options are risky and not for everyone. The real lesson: have a plan before volatility hits. That plan might be diversification, strict sell rules, or simply holding for the long term. The tool matters less than the discipline. Don't react emotionally. Prepare rationally. That's how pros survive the storm. The biggest risk in a correction isn't the first drop. It's the panic that follows. Retail investors, seeing losses, often rush to sell, creating a self-reinforcing spiral. When many sell at once, funds must liquidate gold, pushing prices even lower. This herd mentality can drive prices far below fair value. We saw this in Japan, where a gold ETF bubble burst as investors stampeded out. If you bought gold for the right reasons, as long-term insurance, a short-term drop shouldn't shake you. Know why you own what you own. Conviction and a plan keep you from joining the panic. Gold's price is tied to global policy decisions, especially from central banks. The US Federal Reserve is expected to cut rates soon, making gold more attractive. Political chaos, like the ongoing US government shutdown, adds uncertainty and weakens confidence in the dollar. Globally, countries like Japan and the UK are also taking drastic economic measures, fueling fears of currency debasement. All these moves ripple through markets and impact gold. Don't just watch the price chart, look at the bigger picture. Are the reasons you bought gold still valid? If the fundamentals haven't changed, a correction may just be a test of your resolve. Stay focused on the long-term story. After the rally and the crash, what should you do? My advice? Pause. The worst time to make big decisions is during panic or euphoria. The drop was driven by traders and algorithms, not a verdict on gold's long-term value. Ask yourself, why did I buy gold? Has that reason changed? What's my time horizon? Does a bad week really change your long-term plan? Is your financial house in order? Gold is part of a plan, not a replacement for one. Despite the drop, gold is still up nearly 60% this year. Volatility is the price of potential high returns. There's no reward without risk. Don't let hype or fear drive your choices. Review your plan, understand the facts, and act deliberately. Smart investors are patient and disciplined. Take control with knowledge, not emotion.